Okay, so I left off on the inventory turnovers, but I'm going to repeat this slide again because generally the last few minutes of class is what you pay least amount of attention to. And the first 15 minutes of class is where your attention is the greatest. So inventory turnovers, as far as stocks are concerned, we like companies that are reducing their inventories, who are increasing their turn rates. So we want to see a higher number here. The higher the number, the better. And what we want is for a company to be efficient. So we don't want, say a grocery store to buy a year's worth of food and then take a year to sell all of it. For a grocery store, keeping in mind that many people pay close attention to expiration dates. Have you ever ever bought something from a grocery store only to get home and realize it's spoiled or expired? It's a real hassle. So a lot of people will go in and actually sift through the milk and the eggs looking for what's has the best expiration date, or a lot of things could last. If it's a dry food, it could last a couple of years, but you still don't want. There's a big difference between Raisin Bran that's going to expire in 2 months and Raisin Bran that's going to expire in 2 years. So it wouldn't be a good idea for a store. Even soda has expiration dates on it. Can you believe that? Soda? I thought that stuff never expires, but because of foods expire, you wouldn't want to have a year's worth of inventory. You probably, if you were a really efficient supermarket, maybe a week's worth of food. So you could do inventory turns 52 times a year. Just think of it. On Monday, you fill this grocery store up with everything you know you're going to sell for the next week, and by Sunday, it's all sold out, and your new stock is coming in Monday morning. Now, it would be 52 perfect turns. Now, nothing is that perfect. It's kind of messy. Some things sell faster than others. Some things sell slower, but you still have to have some of it on the shelf. So it's a more complicated process to really make an efficient turns. Ideally, you'd want to be 360 turns if you could, or sort of a just-in-time inventory. Have you heard this operational phrase? So a lot of the computer manufacturers, the auto manufacturers, what they want is to figure out the amount of inventory they need for tomorrow, order it, and get it delivered that night or the next morning. And that's why they call it just-in-time. And that's to really reduce the amount. So the auto industries were able to reduce from billions down to only a few millions of inventory, spare parts, and assembly materials and raw materials to make their automobiles, and those billions that they save by reducing their inventories help to increase their cash flow and profits. Where did all this inventory go? They pushed it on their suppliers. The suppliers had to set up a tire shop next door, and the suppliers are holding the inventory, and then they could just deliver it within 20 minutes of the order. So that's how the auto companies were able to basically move their inventory off onto their suppliers and say, if you want to do business with me, you need to set up a distribution point where you can get your inventory to me within the hour. And a lot of the department stores do the same thing, such as Walmart is very efficient at knowing exactly what's on their shelf, how fast things sell, and reordering to get it in stock the next day. So on a routine business, predictable day, they know exactly how much stock they're going to need and what they're going to sell, and they can easily replace it the next day. So the only time these department stores will have stock outs is if there's a sale that has greater demand than they expected, or a new item has greater demand than expected. And that's why generally around Christmas time is harder to really understand and know what toys are going to sell out, what toys are going to sell slow, and things of that nature. But the point is, for stock picking purposes, we want companies that are reducing their inventories and investing capital to make the inventory structure as efficient as possible, to have the least amount of inventory. And, in any of your kitchens in your house, you probably have hundreds of dollars of inventory in supplies and food and spices and frozen and fresh food in your kitchen. That if, like I used this example last time, if you were just able to say, you know what, I'm not going to buy any food until I consume everything in my kitchen, you may be able to I could probably last 2 or 3 months on that until everything is gone, down to that last bag of 20 pounds of rice, eating rice every day until that's gone. And then I would save all that money in food for 3 months. All right. Now, total asset turnover is looking at the sales in relationship to the assets. So how how much you need assets to generate sales. So for example, if you're in say you're a laundromat and you have 2 washers and 3 dryers, there's a finite amount of sales you can have in that laundromat. Agreed? Now, if you were able to expand that to 40 washing machines and 50 dryers, you can make a lot more sales, but you greatly increase your assets to do that. So you would want to, if in the other example, 2 washers and 3 dryers, if they were running continuously for 8 hours, the store is only open for 8 hours, and now you expand to 40 washers and 50 dryers, but they're not all running continuously. We'll say their capacity is at 80%. 80% of the time the machines are running, 20% of the time they're waiting for someone to use them. So it's not as, the assets wouldn't be as efficient, and the total asset cost to total sales, so your total asset turnover may actually be lower if you expand your assets greatly and your utilization lowers. So at 2 washers and 3 dryers, utilization is 100%. There's never a minute where they're not. There's always someone waiting to use it. You expand your laundromat, you greatly increase your sales, but utilization is lower. The total asset turnover may actually go lower now because you greatly increase the amount of assets at the bottom. So one way companies have been trying to, we like companies who have an ever-increasing total asset turnover, meaning that their assets are generating more and more and more sales. One way, easy way for a company to do that is to expand their hours from 8 hours to 15 hours a day. So now, if I'm increasing, my utilization may actually go lower, but since I'm using it for a bigger period of time, I'm getting more sales for my assets. So why not go 24 hours? Even if overnight from 1 a.m. to 5 a.m. the utilization is only at 20%, that's still 20% sales I wouldn't have gotten anyway if I was closed. So by expanding your hours of operation, you could get more sales out of your assets. And that's why you see some fast food restaurants like McDonald's are open 24 hours. And some businesses that, where it makes sense, they'll be open if they could generate additional revenues through the same assets. It's the same idea with factories. If you have a certain amount of, say you have an automobile factory that only operates for 8 hours a day, and you're selling, maybe it makes 600 Teslas a day, but you have orders for 5,000 Teslas a day, the first thing you would do is not build another factory. You would go put a second shift on, and then a third shift, so that one factory can make 1,800 cars. Now it's at 100% capacity utilization. You can build a second factory. So you don't build 3 factories that each make 600 cars a day on 8-hour shifts. You make sure that the existing factories can run 24 hours first before you spend all the money in capital and increase your assets to build that second factory. And you don't build that second factory until you definitely have enough orders to support at least a 50% capacity on that factory. So every time a company is going to buy or deploy an asset, they're going to look at their total asset turnover, the sales it could generate. So if it's going to generate sales that make sense, they're going to do it. Common sense though, if you're a business owner, you run a pizza store, you're not going to invest in 3 new ovens if you don't have the demand to use them. If you go down to, there's a Red Mango by me that closed because they couldn't generate enough sales in the winter to support the assets in the store. So the assets in the store are all those expensive yogurt making machines, like 5 or 6 of them, to make all those different flavors of yogurt. And then I guess maybe the inventory for the toppings and stuff like that. You need a lot of sales to support the cost of those assets. Because they take energy, people to run them, people to clean up, and toppings. And so in some cases, if you have a store that has that much cost, that much assets, it's going to be harder to survive. So that's why we're investing in stocks. We look at this asset utilization and total turnover of assets to see how efficient they are. You may have an ice cream shop 2 doors down that just has refrigerators and buckets of ice cream you scoop out, and very minimal asset investment. They can generate a lot more sales. Even if they generate half the sales of Red Mango, they're still ahead of the game because their $10,000 in assets are generating $100,000 in sales, which is better than investing $100,000 in assets and only generating $150,000 in sales. So sometimes the extra assets aren't really worth the extra sales. As a manager, you have to judge that. And as investors, we judge a company and we want to see that they get the most out of those assets. That's why in the airline industry, A plane doesn't fly once a day from New York to Miami, and that's done. That plane can go from New York to Miami a few times a day because that's their asset. They want to get as much sales out of it as possible. In fact, you know, if it's say Southwest, the airline might go from New York to Miami to Austin to Las Vegas back to New York. You know, they want to operate that plane, keeping the air as many hours as possible to get this utilization. In fact, Southwest is so efficient at this utilization that they're having a lot of delays in their flights because anytime there's an unexpected snow or a delay or a flight crew delay or a baggage sorting delay, it piles up. So at the end of the day, the last flight, it could be an hour delayed because they haven't left a lot of room for any downtime during the day because they're running their planes so efficiently to increase the total asset turnover. More planes flying more legs equals more sales and more people in the seats. And if you notice that it used to be a number of years ago, the airline industries, the planes weren't full. But now with software and a little sophistication of their network, they've been running their planes a lot more full based on analyzation of schedules, and they have a lot more data and mega data to analyze, and they're much more easier to keep these planes full, which increases the asset utilization because they're getting more sales out of the same asset because the planes are full now. But as passengers, we don't like that because now someone's going to sit in that middle seat. We like to have one seat between us, right? I got on the plane a few weeks ago, and somebody sat next to me, and they just weren't the same size as the seat. So luckily, though, they found there's a family of 3 of them. They found a row where they could sit, and then the guy moved. So I had that empty seat, which was really, after being smushed in with 3 people in a row and you get back to 2, you really appreciate that empty seat. But then the plane was full, so someone else eventually took it. So it didn't last for long. But those 5 minutes I had that empty seat was great. Now moving on, debt to equity ratio. Here we're trying to get an idea of how much debt, what's the relationship of debt to equity in the company. So the assets are made up of 2 sources of funding, debt and equity. Just like if you buy a car, you put money down on the car is made up of 2 sources of funding. Your equity, the money you put down in the car, and the money you borrowed on the car. So if you have a $20,000 car, you borrow $15,000 and put $5,000 down, what's the debt to equity ratio? And you would just take the 15, long-term debt 15 divided by the equity of 5,000, and you'd have a multiple of 3. What if it was you put $1,000 down and borrowed $19,000? What would the multiple be then? 19 divided by 1, 19. So that's higher. So the higher, the more risk. It means the more debt the company has borrowed. So we're looking at a relationship between debt and equity. We like equity because it comes at a lower cost and it doesn't have to be paid back. It's money that was invested in the company or retained earnings the company made that they bought assets with. So it's a lot more stable to have more of your company funded by equity than debt. So that's why we like a lower ratio, signals less risk. So if we're looking at analyzing a stock, we want to see that the trend in the debt to equity ratio is going lower, not higher. So we want less risk. Okay, the times interest earned is looking at the company's ability to pay its interests. So we look at earnings before interest and tax divided by interest expense. You know, if we're going to do this on a personal scale, we'll say that you make $1,500 a month in income, and you have $500 of interest expense on your credit cards and student loans you have to pay a month. So that would only give you a times interest earned of 3. That's not very high. I'm sure you would agree that if you would much prefer to make $5,000 a month and have $500 of interest to deal with. Now you have 10 times the times interest earned. So for a company, we like the higher the number, the less risky it is. The more money they're generating in relationship to the interest they owe on their debt. So if you're analyzing a stock to buy a stock and you see that the times interest earned is creeping lower, that's more risk, and we may not feel the stock is as valuable. Because remember, this chapter is all about using fundamental analysis to discover the intrinsic value of a company. And in order to discover the intrinsic value of a company, you have to take 1 million points of data. That's probably the maximum points of data you could take. But in your case, if you're doing it just with the financial ratios, you may only have 25 points of data, if that's what's available to you. And that means you have to use as many points of data as you could develop or you find useful. You use all those different points of data to basically give you an idea of what the company is worth. And each investor develops their own particular points that they would like to look at. You may find that I only need 20 points of various financial ratios for me to come up with what I think a value of a stock is. In fact, actually, people can make formulas based on different weighting different financial ratios at different amounts to help you develop a factor of intrinsic value. So there's a lot of numbers games that can be played with all this information, but when you boil it down, you're basically just trying to sum up many different factors to figure out whether or not this company is worth it. Okay, just like you may say you're looking at a potential girlfriend and you may say, I don't know what her intrinsic value is. And if she has a particular amount of intrinsic value, that means you're going to date her. If she's below the level of intrinsic value that you're looking at, you're not going to date her. So you add the things up. There's a lot of different things. 1, she's pretty. 2, she's good in bed. 3, she doesn't have, she likes to clean my apartment. So these are all good things adding up to why the intrinsic value will be higher than a girlfriend. But then some things may be negative or not looking good, like 4, she talks too much. 5, her parents are nosy and wants to meet me. 6, she has 8 evil ex-boyfriends. They're going to beat me up. I mean, these are all different things. You have to balance and weight all these different factors to figure out whether or not this is someone you want to date. The same thing with a stock. You have all these different points of intrinsic value that you're going to have to kind of balance out and figure out, is the stock worth it? And if you ever watched How I Met Your Mother, Barney comes up with that chart of hotness and crazy. And it's sort of like, if the girl is really hot, you can deal with a certain amount of crazy that compensates. But if the girl is not hot and very crazy, you wouldn't date that person. If the girl is very hot and only a little crazy, then you definitely go for dating that person, And let's face it, everybody's a little bit crazy, so everybody has a factor on that crazy scale. There's all things we do that are a little crazy that make no sense, right? Yeah, so we'll have to see. I haven't watched the show in seasons, so I don't know what's been happening, but I'm sure they found the mother by now, and then they're going to get married in the finale. But I'd rather not watch the finale of shows because they're always disappointing. And in this mind, I can always, if I don't see the finale, I can always keep watching the reruns and enjoying them. Once I see the finale, that's it. Like the Lost finale, you see the Lost finale, there's no reason to watch Lost anymore. It just ruins the whole show. So you'd be better off not watching the finales. Okay. Net profit margin. If you took my finance class, 330 finance, you would understand net profit margin pretty well. And I think any of the classes for accreditation, we run a simulation. And in part of that simulation, you have to really understand your net, gross, and operational profit margins. And again, it's common sense. The higher, the better. So the net profit margin is really the bottom line. And this is one thing I put a lot of weight on as far as a point of data, is what is the company's net profit margin? And is it increasing year over year? Is it going up? So I want to invest in companies who are able to increase those profit margins. And net is basically after all the expenses and all the costs are paid, and the taxes are paid, and the interest are paid, the net is the money left over after all of those expenses and costs, and divided by total revenue. However, it's a percentile, and we would want to compare it with other companies in the industry. We don't want to compare an automotive company's net profit margin to a software company's net profit margin. This is not comparable. So we stay within industry. So if we looked at operational and gross, those are 2 other profit margins that are important. So gross would really be how profitable the products are of the business. Operational would be how profitable the business is. And net is really how much money shareholders are going to get, because operations stop at one point, and then after operations you have taxes and interest that aren't part of running the company, but are costs of running the business that investors have to be deducted before you get your net income. So you have those three levels of profit margins: gross at the top, operational in the middle, and net at the bottom. And they're all three are important to analyze and look at. And you may find in an industry, say the fast food industry, McDonald's has a very high gross, but a more average operational profit margin compared to some of their competitors. And the reason for that is their operational costs are high because they spend a lot more money in advertising than some of their competitors. And you may find something similar in the soda industry. If you have, Coke and Pepsi do probably a similar amount of advertising, but if you have a third, like Royal Cola, or a third type of competitor, you may not see as many commercials for them. So they're operating on, some soda bottlers will operate on selling soda at a lower price and not advertising as much, maybe doing more in-store promotions and things like that. But I assure you there are more than two soda companies, but you may only be able to name Coke and Pepsi. There's also, well, actually, a lot of times they buy some of the smaller ones, so I don't know who's left, but there used to be like Royal Cola. Actually, Dr. Pepper used to be its own company, and I think one of the companies bought them. Canada Dry, the ginger ale company. Okay, moving on. Return on assets. So we're looking at the net profits after taxes, which they always are, divided by the total assets. And this gives us what's the percentile return on my assets. So again, this is sort of like the figure that we went over earlier when we looked at sales to assets. Now we're looking at profits to assets, and this is going to be a percentage. We want to know, are our assets profitable? So if we have two identical laundromats that have the same amount of sales per hour, same amount of equipment and assets, and the same equal sales per hour, if one company is open for 16 hours and one company is open for 10 hours, we're going to definitely have a higher return on assets for the company that's open and longer that's going to make the same money per hour. So anything companies can do to improve their profit generation of their assets, the better. So some ideas could be figuring out a way to reduce the cost of fuel or electricity for their assets. So if their assets are factories, maybe there's a way of installing solar panels or buying more efficient equipment or switching to a lower cost fuel. If the assets are, if you figured out how to make your product, maybe in the past you had a big complicated machine to make your product, was an expensive asset, then you decide to sell that machine and have somebody else make your product for you as an outsourcer. And that would lower your cost of your assets. It would also lower your profits, but because someone else is going to charge more rather than you can make it at your home factory for less, but if the cost of the asset's so much, maybe it would be beneficial to outsource it. The airline industry, most of the airline industries don't own their own planes. Did you know this? The planes were such huge assets that they figured out that if I leased the planes from Boeing, I could reduce my assets on my balance sheet and increase my return on assets greatly. And then, now Boeing, just like an auto company, they want to sell as many planes as GM wants to sell cars. So they're very cooperative when it comes to leasing. Just like if you were to lease a car, they're very cooperative, and it's a lower monthly payment to lease a car than buy it outright. So for the plane industry, leasing just made common sense. I don't have to borrow a bunch of money. I don't have to buy all these planes. I could just lease them and operate them for 10 years. And when the lease is done, Boeing will take the planes back, and I can lease new planes. So I can actually have newer planes more often if I lease, just like you could have a newer car, drive a new car every 3 years if you lease rather than if you buy. Now, generally, leasing is not as good of a financial deal as buying outright. But if you're a company trying to increase your return on assets, you want to lease as much as possible. That's why they're the Sears Tower in Chicago. One point, Sears owned and operated that tower and ran their business out of their tower. And then one day they just realized, you know what? Let's just sell this tower. It's a slow returning asset, and we'll just lease out space inside of the tower for our business. and we'll be able to cut out a huge asset, and so but our net profit margins won't change that much. So we'll actually have a smaller asset base and a higher return on assets. So companies are going to constantly look for avenues where they can do this. Because investors, if you're investing in a company, you want to see an increasing return on assets. Because the asset is basically, as an investor, you're like buying those assets. Those are your assets. Just like they say, ever hear this when someone says a house is not an asset? And the reason they say that is because a house just sucks money out of you. There's no profit. It's not returning any profits. So if you buy a house, the return on assets on the house are negative because you have to pay for utilities and you have to pay taxes and a mortgage. Unless you buy a house and you rent it out, now the house produces a return on that asset. So a house really isn't an asset that has any type of return unless it's making you money. The only exception would be is that if renting was a lot more expensive than owning a house, then you could get a return on the house because it would be cheaper to live. And actually, the longer you own a house, the cheaper the cost of operating the house becomes because you pay your mortgage down, and you're paying a mortgage on the price when you bought the house. 20 years later, new houses could be double the amount, but you're still paying a mortgage on a house that's half the amount, and you only have 10 years left. After 30 years, you completely pay off your mortgage, and now you're just paying taxes and utilities. So over time, you get a higher return on the house, but in the beginning, you have a lower return, a negative return on assets. Maybe at one point, your house is paid off, your family has grown up and moved out, now you can rent part of your house out and turn it into more of an asset, or lower the negative rate of return on assets. So companies kind of think the same way. If a company has a business and they have extra space, they may think of renting it out to another business. Ever go into a hotel and you see a Starbucks inside a hotel? And then you go inside the Starbucks and you see another Starbucks inside the Starbucks? This is a way of generating more revenue from the same space. So you could rent out all these little places. Oh, here's a good example. Go to any mall these days, or go into a time machine and go back to the year 1987 and go to a mall. There are no kiosks in the mall. There's plenty of open space just to roam around in the middle of the mall. You could do whatever you want. You could dance. It was great. But now they pimped out all those hallways and put kiosks that are $1,000 a month to rent those kiosks and sell T-shirt and Dead Sea salts and overlays for Apple iPhones and cheap jewelry and those little airplanes that they fly around, or those little balloon dogs, the little feet, or the sculpting where you can sculpt your picture inside that piece of plastic. Ever see that one? Or the graffiti T-shirt artist. What am I missing? Oh, yeah, it's a big one, too. They actually have they have an elevated kiosk. It's actually glass cases where they sell not just any perfume, all the knockoff perfumes. If you like Dolce & Gabbana, you'll love this brand, D&G. So, the funniest story I have about perfume is I went to this store called Odd Job. Is that it? No, Odd Lot is closed. They have, I think it's Odd Jobs or Big Lots. That's it. Big Lots. It used to be Odd Lots. Now it's Big Lots. They had I had to laugh. I bought this as a gag gift for my friend. They had superhero colognes, $2 a bottle. They had Hulk, Captain America, like taking from the Avengers popularity, and I just had to buy it to see, one, to give it as a gift, and then two, kind of see what does the Hulk cologne smell like. It can't be good. But, okay. No. Return, it was bad. It was like the Hulk's armpit. It smelled radioactive. It was green. But it made a good gag gift, Some celebrity, I watched a show called Episodes, and they have Joey from Friends, Matt LeBlanc is the star Episodes, and in it he has one episode surrounds the fact that he has his own fragrance that he has boxes and boxes of because it never sold. And it smells like cinnamon buns because he liked to eat on the show or something like that. Anyway, return on equity. Here we're looking at net profits after taxes divided by shareholders' equity. And again, equity is a part of the company you own. So you want to see what type of return am I getting from my investment. So if you were to buy, say you were to buy one of those giant laundromats, that could cost $1 million. If you put $1 million cash down on that business and it generates $200,000 in profits, your return on equity is 20%. What if you borrowed what if you borrowed $500,000 and you only put $500,000 cash down? So 50% of the business is your equity, the $500,000 cash you put into it, and you borrowed the other $500,000. Now your return on equity, instead of being 20%, it doubles to 40%. What if you could buy that business for $1 and borrow the rest of the money? Now your return on equity is even higher. If I was allowed to buy $1 million laundromat that was profitable for $1, I guess my net profits would be lower because I have to pay more interest. But if it still was profitable, I'd rather buy 1 million laundromats for $1 that are all profitable than one laundromat for $1 million. It's just leveraging my equity. But it's inevitable that the equity builds up in a company. So if these laundromats are profitable and you have to pay back these loans, you start paying down these loans, your equity starts to creep up. And the way we kind of look at this is if the equity is getting too big, the return on equity is going to shrink. So the more equity you have in relationship to profits, the smaller your return on equity. So we do like a higher return on equity because it means we own more of the company, but it may get to a point where it may make sense for the company to take some risks, borrow some money, and expand the operations. And I'll give you a story of two franchises: McDonald's and In-N-Out Burger. Have you ever been to an In-N-Out Burger? It's West Coast, and it's better than McDonald's. They have a secret menu. It's just really great there. In-N-Out Burger, and it's like a red lightning bolt is their logo. If you ever go to Las Vegas or California, check out In-N-Out Burger. Now, In-N-Out Burger decided to increase their equity and not borrow any money and not expand. Because they just wanted, instead of using the money to borrowing money to expand their locations, they decided not to franchise, which is the ultimate amount of leveraging, and just kind of keep it in the family and only have like 20 locations. Or 30 locations. McDonald's went the other way, and they said that my idea, I'd rather have 1 million McDonald's with $1 of equity in each McDonald's than 30 McDonald's fully paid off. So they went and over-leveraged. Which company today do you think makes more profits? McDonald's, because it's a billion-dollar profitable business, multi-billion-dollar profitable business, because they used borrowed money to greatly expand their business. They had a franchising mechanism, but you get the point. So if a company starts building up their equity too high, then it starts to lower the return on equity. So if you have a lot of equity and a small amount of profits, you're going to have a lower percentage. So as your equity builds up, the percentage goes lower, and that's why sometimes the higher the better, because we want to be able to take that equity and invest it in another business, thereby lowering the equity and having a higher return on equity. So ideally, we would want, and it kind of makes, it's not so intuitive. You want to own less of the business? Yes, if I could own, rather than owning one pizza restaurant 100% with all my money, I'd rather own 4 of them, only have 25% of the money be mine, the other 75% be borrowed. So more leverage, but I have 4 restaurants, each making $75,000 a year, rather than one restaurant making $75,000 a year. So if I started to build up a lot of equity in that all 4 of those restaurants, and one day I wake up and I paid off all my debt, I own 100% of all 4 of those restaurants, investors would be disappointed. They would say, listen, borrow more money on those assets and open up 16 more restaurants. But my return on equity is going to go up. Yes, make it go up. Borrow more money, expand, and reduce your overall return on equity on the individual stores you have right now. And use your equity to leverage your business higher and borrow more money. So this is why, as a stock investor, we don't want this ratio to go too low, because it means that there's too much equity hidden in the business. We want to unlock that equity and invest it elsewhere. It's sort of like you get your paycheck every week and you put it in a shoebox under your bed. And so you have a lot of equity, all this cash in the shoebox, but you're not really getting any return for it. Wouldn't it be better if you went out and bought stocks with that or other businesses and just kept, and then wouldn't it be even great if you could borrow money on margin or borrow money from banks to buy even more businesses? So you see how companies like a shark, they have to constantly consume and constantly grow bigger and move forward. So that's why as investors, we like the company to have a certain level of equity so it's stable and safe, but we don't want to pile up so much equity that it just becomes a waste. We want to be able to move forward when we have enough to open up the second store and then build. So you open up the second store, it's a little risky, but eventually you're making money, you build up equity, you open up a third store. And that's how, these franchises or these multi-location businesses make money. For example, the Chipotle Mexican Grill is not franchised, it's company owned. That's why it hasn't been expanding that fast, because they're waiting to get a certain amount of equity built up, and then they open up a new location. So it's expanding not as fast as a franchise could expand, though, because they could get access to more capital quicker. But, right now, I've counted in Suffolk County, we have 3 Chipotle Mexican Grills. 2 on Route 110, 1 in Melville, 1 in Farmingdale, and 1 in Hauppauge. Oh, okay, 4. There's 1 in Tanger Outlet. That's true. I've been to that one. How could I forget? So there's actually 4 of them. I've been to all 4. I forget the one in I don't know why I do that, but if you look at something like Red Mango, there's probably like 16 of them in Suffolk County. So that's a franchise. They could move quicker because they can build up. Since they're dealing with multiple sources of people, they can get more debt quicker, so they can expand faster. But if I had my choice between owning 18 if my choice was owning 4 Chipotle Mexican Grills or 18 Red Mangoes, I'll take the 4 Chipotle Mexican Grills because there's too many of those yogurt places. Swirls and Twirls, Sweet Frog, Chiller, Cool Monkey. Pinkberry, well, that's the original. That's like the golden standard. I'll take one of those shops. Those are good. But there's so many of them that, you know what? After you do that a couple of times, you realize, why am I spending $6 for a little cup of ice cream? Or not even ice cream, frozen yogurt. Yuck. Okay. We could look at return assets a little bit more closely. All right. This up a bit. Okay, so if we take net profit margin and we multiply it by total asset turnover, we can also calculate return on assets. So it's sort of like, because these are using similar inputs, we can take the shortcut, net profit margin times total asset turnover, and we get the return on. We also get the return on asset multiplier. So if this is changing, it's a function of either increasing profit margins or increasing total asset turnover. So either one of these, either one of these change, is going to affect return on assets. So we want to have higher net profit margins, and we want to have a higher total asset turnover, because that's going to give us a higher return on assets. So one way you want to figure out, well, what's the company's problem? Is it assets, or is it utilization of is it profits or utilization of assets? So if the profits are remaining steady or going down, we could see that the return on assets, the reason it's not moving higher is because profits are not there. So this is just a formula to kind of break up the idea. Is it the profits holding the company back, or is it the total asset turnover holding the company back? And it could, for some companies, it could be either or both. But if we knew it was just profits and not assets, then we know that we'd have to do something to make ourselves more profitable, because the assets are turning over fine. We're getting plenty of sales out of our assets. We're just not getting enough profits. So it could be a function of, maybe it's the cost of our raw materials are more expensive now. So we'd have to figure out, if you're a food company, say you're a food company and your return on assets are going lower, and you're saying that we're selling as much peanut butter as we've always sold, but our profit per jar of peanut butter is lower. So return on assets. So what are we going to do? We want our profit margins to go higher. So let's let's make the jars of peanut butter be smaller. We'll dimple the bottom, we'll push the bottom up, and we'll contour the middle, and we'll have less peanut butter but the same looking jar. So people will never notice the difference, but they'll pay the same amount of money, and we can increase our profit margins. And let's do that to our Haagen-Dazs ice cream, because we used to sell Haagen-Dazs as a pint, but now we sell it as 8/10 of a pint. That's why if you buy Ben & Jerry's, it says still a pint on it. And the reason it says still a pint is because everybody else says, if you compare the two together, you're like, what happened to my Haagen-Dazs? You know, so generally a lot of sizes, yogurt especially has been declining too. Cereal boxes, you know, amount of Oreos you get in Oreo cookies, the amount of sheets and paper towels, they've all been decreasing because they're trying to increase their profit margins. They don't want to reduce their total asset turnover. They still want to sell as many bags as Oreos as they can, or any boxes of cereal, many jars of peanut butter. They don't want to change that. But actually, by decreasing the size of it, we'll sell the same, if not more, if people run out faster now, and we'll have a higher profit margin. So that's why your food is shrinking. You're not getting bigger. Your food is shrinking. So you don't go to the supermarket and say, I must be ginormous now because all these packages are so small. No, you're not changing your size. The food's getting smaller. But why not? Well, how come I'm not losing weight then? Because you're eating the same amount. You're just buying, instead of buying 10 bags of Oreos a year, you're now having to buy 12 to get the same amount of Oreos. Because you eat 2 Oreos every day after lunch, or 5 Oreos every day after lunch. However you work, you're eating the same amount of Oreos, but you're buying Oreo bags more. You're eating the same amount of peanut butter. When I travel to a foreign country, I always bring my peanut butter with me because they don't sell it in foreign countries. It's hard to find. Peanut butter is a very American food. You know, you're not going to find, you go anywhere else in the world, you're not going to find a whole shelf dedicated to 14 different kinds of peanut butter. You may be able to find one jar of peanut butter shoved in the back somewhere. Same thing with breakfast cereal. If you're a fan of breakfast cereal, you travel, make sure you bring it with you because they're not going to have sugar smacks. Or honey smacks as they call them now. When we were kids it was sugar smacks, but you can't say sugar anymore, so you can say honey. Although if you go to Canada, you can get ketchup potato chips. Potato chips that are flavored with ketchup. Delicious. You don't dip your potato chips in ketchup ever? No? Do you dip your french fries in ketchup? No? Does anybody dip their french fries in ketchup? Yeah, that's very American. What's the difference? You know. But I prefer sour cream to dip my french fries in. But can't always get that. Anyway, moving on. Return on equity. We can also take return on assets, multiply it by the equity multiplier, and the equity multiplier is the total assets divided by total shareholders' equity. So basically, the equity, how many more times of assets can we purchase for equity? So if I put in $100 and buy a $1,000 machine, my equity multiplier is 10. So I can take my equity and multiply it by 10, and that's the size asset I can buy. So a $100 bill is my equity. I can buy a $1,000 asset with that. So we would say my equity multiplier is 10. So if I take my return on equity, multiply it by my equity multiplier, I get magically my return on equity. So these, again, it's the same formula. It's a different way of calculating the same ratio. But this way, we can kind of get a better understanding of what's involved in when the return on equity changes. It's going to be involving the return on assets and the equity multiplier, which is involving the assets to the equity. So investors want to know if return on equity is moving up. Is it because the company is taking on more debt, or it's because the firm is having a better managing of its operations and assets? And we would want it's managing its operations and assets better. So when you look at these ratios, you sometimes get an idea of whether or not some ratios are confusing. We're not always sure if they're good or bad. But if we look deeper into the ratios to see what variables are making the ratio up, we get a better idea if it's good variables contributing to it or bad variables. Just like, for example, go back to your potential girlfriend. She looks like she has lots of money, right? You go out, she buys dinner, she drives a nice car, she lives in a great apartment, and then maybe you do go out with her, and maybe you marry her. And guess what happens on the wedding day, the wedding night? She says, oh, by the way, I have $65,000 in credit card debt, $80,000 in student loan debt, and I also lease the car, so I don't own that, and the apartment The condo I was also leasing, and I don't own that, so I really have a negative hundred something $1,000. Just by the way, so you would really want to know before you marry this person, and it doesn't have to be a girl. A guy could do the same thing. I'm not being sexist here. It's just that he happens to be a guy, so I'm not going to say, I'm going to use the example this way. If it was doing you, I'd do, the other way. And if someone was gay and I knew it, I'd just do the same-sex partner. So whatever. So I'm not trying to put women down and say this happens for women only. It can happen to anybody. But it's pointed at your case. So anyway, before you marry her, and this is for anybody, guys or girls, whoever your partner is, hopefully it's a human being, you want to open up, talk about their finances before you marry them and figure out that you just married someone who put you $300,000 into debt because now you're financially tied and linked to them. The best solution is just don't get married. That way, just get a love certificate. Right? It just proves that you are marrying your love for each other, not your financial assets. Unless you're marrying for money, then that's different. Then get married, right? I was watching 60 Minutes last night, and they had the guy on that invented the Tesla, and then they had his new wife on. And would you think that his new wife is pretty or ugly? Right? And do you think that it took them 2 weeks to get married or 2 years of an engagement to get married? 2 weeks. So someone there married for money. Somebody else. Sometimes you marry for beauty, I guess, but you never marry for love. That you just get a love certificate, which I sell if you need one. You have to go through rigorous tests to make sure you're in love first, then you get that love certificate, and that's all you need. All right. Okay, now the common stock ratios, PE ratio is another one that's a little bit tricky. It's simple to calculate the price of the stock divided by the earnings per share. And the earnings per share is a formula that you should be familiar with already. It's net profits divided by the amount of outstanding shares. So we just calculate the earnings per share of stock. So you have your total earnings divided by your outstanding shares, and you get your earnings per share. So we look at what's the stock price in relationship to the earnings per share. So if you watched the video I put up about the valuation of Yelp, which, by the way, since I put that video up and claimed it was overvalued, it's gone down significantly. I don't think that had only 300 people watched it, so I don't think they really had a relationship there. But the stock price was hundreds of times above the earnings per share. So that's not realistic. The PE was just too high. PE should be around a historical average between 12 and 18. So when you get a company with a PE is 500, there's a problem. Greatly overvalued. So this could be a measure. It's a valuation measure of how valuable people feel the stock is. The higher the PE, the more valuable people feel the stock is. So it can be an indication of a problem. If the PE gets too high, never buy a stock with a PE greater than 100. Those have shown to be greatly overpriced. But sometimes the PE is too low. There may be a reason for it. If nobody likes the company and nobody's buying it and it has a very low PE, there could be problem or trouble with the company. So sometimes you want a PE that looks fair, not greatly overvalued, but not typically undervalued either. So it's sort of like a valuation check on the company. It could be a sanity check too. If you get into a bubble situation and more companies have 100+ PE multiples, then you have a good idea that you're in some sort of bubble. Because no stock can really support 100 PE unless it invented a way to turn water into oil or sand into gold. It just shouldn't have that much of a so it's sort of an expensive ratio. The higher this ratio, the more expensive the stock is. The lower the ratio, the less expensive it is. So it's just giving you just one piece of data to say maybe everything else about the company is great and wonderful, but if it's too high of a sticker price, then you don't buy it. You may really love this particular car, but if they're asking $200,000 for it, you don't buy it. So it's sort of a double check. And this would just be an example of how to calculate it. A PE of 18, and it depends on some stocks. Tech stocks have higher PEs than automobile companies, and airlines have lower PEs than biotech companies. So it depends on the industry. Now, PEG ratio is one way to put the PE ratio in a better perspective. So PE ratio is just 1 point of interest in fundamental value. We can marry it up with the growth earnings of the company to get a PEG ratio. So if the company's PE is 25 and its 3 to 5 year average growth in earnings is 25 also, we convert the percentage to a whole number. So if our growth in earnings is 25 a year, 25%, and the PE is 25, we would say it's fairly valued. So when the PEG ratio is 1, we'd say the stock is fairly valued. If the PEG ratio is above 1, maybe the PE is 100 and the growth in earnings is still only 25, then we have a PEG ratio of 4, which say the stock is greatly overvalued. So anything greater than 1 would make the stock greatly overvalued. Anything less than 1 would make it undervalued. And this is a way of taking the PE ratio and putting it in context to the growth of the company. Because the growth of the company, the PE, the rule is the PE should match the growth of the company. So if the company is growing at 10% a year, the stock PE should be 10. Growing at 15% a year, the stock PE should be 15. And we would consider that fairly valued. So this would be a way of incorporating two pieces of data, the PE ratio and the growth rate in earnings, to come up with a valuation strategy. And that's what we have the PEG ratio for, which I personally do use. It's a good ratio. Moving into something a little less common that we don't look at so much unless we're looking to build an income portfolio is dividends per share. And again, this is just the total dollar amount of dividends divided by the total outstanding shares. And if we're building an income portfolio, we would want to have a high amount of dividends per share. But that's also, you have to take that in relationship to price. So if your company had $100 of dividends per share, you would think that was great until you found out that the stock was $10,000 a share. Then you would be like, oh, that's not so great. So that's why we would want to look at two things: the payout ratio, and the payout ratio of the dividend is looking at how much of the dividend is, what percentage of the dividend it is in relationship to the earnings per share. So if you had a $1 dividend and earnings per share of $5, you have a 20% payout, which is pretty decent. And if a company wants to target and maintain a 20% payout and the earnings are continuing to grow, you know that your dividend is going to continue to grow. One other one we may look at is the yield, and we can look at the dividend divided by the stock price. I don't think I have a slide on that, but if we had a $1 dividend to a $10 stock, we have a 10% yield, meaning that our money invested in the stock is yielding a 10% return or a $1 dividend. So it's another way of looking at it. So sometimes the best way, I think, to look at dividend is either the payout ratio or the yield, because it takes into account the money the company's making or the price of the stock. Now, whenever you hear the term book value, it means equity. So book value per share is basically equity per share. We call it book value. It's a more traditional, older term, but it still sticks today, book value per share. So we take the total amount of the common equity and divide it by the number of outstanding shares. And what it's basically saying is that if you took this company, paid off all its liabilities, and sold all its assets, this is the amount of money you'd be left with. And that's why typically the stock price trades above book value. Because if the stock price traded below book value, the stock price was $5, the book value was $20, someone would buy that company and sell it and make $15 per share. And that has happened on occasion. But generally, companies have a higher stock price than book value because of the potential. Book value just measures the assets after you pay all your liabilities that are left over. Take your assets, subtract your liabilities, that's your equity, or the amount of the company you own outright. Now, if the company has any potential, the stock price should be higher than the book value. If the company has no potential, then the book value would equal the stock price. For example, if the company consisted of just one car and that vehicle was worth $10,000, then the company would probably be trading or be worth about $10,000 because there's no real potential. It's just sitting there. All you could do is sell it for that $10,000. It may even be a little lower. So another valuation point to see if a company is drifting closer to its book value, it may be a more valuable purchase. If it's just drifting down, not for any financial reasons, but other than the stock price is just drifting lower. Maybe it's a weaker market and the market is forcing the stock price lower. The closer it gets to the book value, the more value you're getting when you buy the company. But if the stock price is going down because the company is in a bad business or made some bad financial transactions or has some future litigation and the stock price is going down for bad reasons, then you're not really getting additional value because the company's losing potential. And if it's losing potential and the stock price is being lost because of lost potential, it doesn't matter how close it gets to book value unless it goes before it goes under it, because you're not getting anything more valuable because you're just losing the potential of the stock. So you have to really look at why is the stock price going down. If it's not going down for financial or business reasons, but maybe market reasons, then that could be a good signal of value. Okay, price to book ratio. This is looking at the stock price divided by the book value. So if the stock price is 50, the book value is 25, you have a price to book at 2. And the higher the ratio, the more fully priced the company is. So if you had a stock price of 100 and a book value of 25, now your ratio book to price is 4. So the higher this book to price, the higher the company is being valued. So again, it's just a measure of current valuation. So if a company is really good, you're going to have a high price to book value because the potential is pushing the stock price higher, which is going to make you result in having a higher price to book value. But generally at a certain point this evens out. As companies who are really good and make money, they start paying down their debts and liabilities, their book value increases along with their stock price, and it sometimes can go lower because of that reason. Okay, so I threw out you a lot of different financial ratios to look at with the perspective of buying a stock. I mean, you learn these financial ratios in other classes just to learn the basics of them, and I've been giving you a perspective of how we look at them in relationship to purchasing a stock. Now, you can get ratio analysis. There are companies that produce reports that will do the ratio analysis for you, and you could just look up and kind of learn about. So here's one such example report where they will calculate and list all the financial ratios for you, and they may actually go on to interpret them for you as well. The problem is you need to know if someone's going to calculate the financial ratios for you in the financial statistics, how current are they? Are they based on today's numbers, last month's numbers, last year's annual report? So you always want to ask, where are these numbers coming from and how current are they? So when you interpret the financial ratios, we're looking for trends, and we want to do a trend analysis with the company. A lot like, say you were going to apply for graduate school or medical school or law school. One thing they're going to look at is the trend in your grades. Are you trending higher, meaning your grades are constantly improving, and you're getting closer and closer to more of a 4.0 average on your later semesters rather than your earlier semesters? And if that's true, you're trending higher in your grades, and that's a positive thing for people looking to admit you into a future program. And the same thing for companies. We want companies have the responsibility of having to constantly improve and increase their ratios. Quarter after quarter, year after year, they want to have more sales and more profits and better ratios. But you have to look at it in terms of the industry. So you would want to take all the companies in the industry and develop an average for the industry, and then compare your company to the average. And the idea is getting back to this fundamental analysis. If I know an industry that I really like software, I could take the 200 software companies, look at all their financial ratios, and figure out and try to rank them from best to worst. And if I could rank them, maybe I buy the 50 best and not buy the 50 below it, the 150 below it. So if I can do a ranking system within the industry based on the financial ratios, which are really more comparable within the industry, I can start stacking up the companies from good to bad. And eventually maybe get it down to just 2 or 3 major competitors. if I'm only going to buy one stock in the industry or two or three stocks in the industry. And we look for these points of interest to tell a story. Just like I was using the example of dating, you date someone for a while because you're building all these references of how they react in different situations, what their sense of humor is, what they value, what type of person they are. So you're trying to build a story about someone before you eventually marry them, right? Because you want to make sure you marry the right person, but you can't find that out in 2 weeks. Oh, the owner of Tesla did, but for most people it takes time. So you're trying to develop. And that's why when you invest in stocks, it's not something you do just in one day and look at one stock at one particular point in time. You have, in the best investors, they have a long-term relationships with these stocks. So they've been watching the story develop and following these stocks for a while. So a stock comes out, goes public, you don't buy it right away, but you keep watching the companies develop and how they perform, how they do during recession, expansion, bull markets, bear markets, things like that. And you use all these points of inference to really get to know the stocks that you want to buy better. I mean, I personally follow 300 stocks of this close nature, at least 300 companies I follow of this close nature for years. And every once in a while, the stars align and it's the perfect time to buy the stock. I might have been waiting 10 years and finally I can buy Chipotle Mexican Grill because the recession happened or some kind of event and it went from $580 back down to $250 and I'm going to buy it. And I've been waiting. So all these stocks, I'm just waiting. I know the story. I know the points of information. I keep them updated and I'm waiting for the right opportunity to jump in and buy it. And for many of them, it could take years. And that's why, when you develop these, you constantly have to update these financial ratios. In my case, some stocks I do it quarterly, some stocks I do it annually, kind of just checking in, how you doing, what's going on, how are things improving. So the story is what's going to make you decide as an investor whether or not you're going to buy the stock. So the more pages you read of the story, the better you'll be able to determine whether or not it's a good book or a bad book. You can't read the first chapter and know if this is a good or bad book, or the first page. And many of us, you're just reading the first sentence of the first page and buying or selling the stock based on that. Some people buy a stock and they just know the stock symbol. They don't even know the name of the company. That's reading like the first word of the book. So in order to be a better investor, you have to read the whole book and then the sequels to it as they're published to really be an expert on that stock before you buy it. It's like some of you may be an expert in Harry Potter. You read all the books, you saw all the movies, so if that was a stock, you would know the perfect time to buy it. It's not a stock, so I lost track after the second or third movie, and I never read any of the books. So I would never buy Harry Potter stock. But some of you might be experts on it, and you might know what's the best stock to buy. If it's collectibles, some of you may be art historians and have a lot of knowledge about artwork, and you would know what's a better piece of artwork to buy, and you would certainly know what's the right price to pay for it. Some of you may collect comic books. And after years of collecting comic books, you know what are the key issues and how much to pay for a key issue at a mint price. I know one key issue, Hulk 181. That's the first appearance of Wolverine. So that sells. I know because I used to own it when I was a kid, but I sold it for nothing. I should have held on to it. It's worth like thousands of dollars today. It's the only book I ever had that was like valuable. Okay. So, but there can be problems with these financial ratios. Things could be developing that you have to keep an eye out. So the story can change. Good people can turn into bad people. Great companies can turn into bad companies, can go bankrupt. Things that you have to keep an eye on, inventories and receivables. Are the inventories or receivables growing too fast for the company? That could be a problem. Falling current ratios, if the current liabilities are getting out of control, that could be a big problem. Increase in debt to equity ratio. If the debt is increasing quickly, that could be a bankruptcy issue. Cash flow from operations. If the business operations are throwing off less cash flow or cash flow's in trouble, that's a problem. Any type of off-balance sheet accounts or trickery in accounting or any type of accounting irregularities, that's a huge problem. If a company comes out and they're being investigated or accused of accounting irregularities, just sell that stock and move on. Don't even ever look back. you know, because that never turns out well. Once that specter starts to hang over a stock, it never really goes away. Financial ratios can't always tell you all of this, but they can give you a clue or lead in to look into it more. All right. So let's just review quickly what we were in from Chapter 7. We discussed the security analysis process, including functions of it. We looked at the purpose of doing economic analysis. We described different industries and why it's important to note the industry and why specifically it has different characteristics in it. We looked at the basics of fundamental analysis, why it's used and how it's helpful. Inside that, we talked about the financial ratios and financial statement analysis that you can use to gauge the intrinsic value of a company. And we looked at various financial measures to assess the performance and explain different insights about a company to get that valuation process. So the whole point of this chapter is you need a lot of information to accurately buy a stock or sell a stock based on the fundamentals. When we say the fundamentals, we mean the operational financial statements and ratios of a company. Those are the fundamentals. So you need a lot of different key points of data, and you need to be able to develop a relationship between the different points of data to know which ones are important, I should really focus on, which ones don't matter much, and how they interact together. Because they're like chemicals. You put certain chemicals together, there's an explosion. Put other chemicals together and there's a rapid expansion. Ever do that in chemistry class? Or the chemistry mixes this, mixes that, and this big foam comes out. So you need to know the key ingredients or the key combinations of things that make stocks great and makes them great investors. And if you could see the formulation of these connecting points of data early on and invest before most people invest, then you're going to reap most of the rewards. So this is just an important, and you don't become good at this until you have years of actual practice and training in it. So you don't think that you could graduate from this class and start investing in stocks immediately and make tons of money. For me personally, I learned $1,500 in a brokerage account, and 5 years of losses taught me all I needed to know eventually to start making profits. So I had to make and lose money for 5 years in a row, make all the common mistakes, buy stocks on advice, not look into the financials, just do what I thought was right without any real backing, financial or statistical or informational backing of anything, not really understanding what I'm doing. So one by one, making all these mistakes was my education. And eventually, after most people give up after a few years, especially when they're losing a lot of money. But if you stick with it, and hopefully this class will cut out a lot of the common mistakes that I made because I didn't have an investing class when I first started investing. You know, so you could not make a lot of those same mistakes I made. So eventually get to a point where you're an efficient investor who is making money and who's consistently, hopefully 6 out of 10 times you're making money, because that's all Peter Lynch says it takes to be a successful trader. So if in one way 6 out of 10 times works is when the sooner you can recognize the 4 times that you're wrong and losing money, you sell those stocks. And if you can recognize the stocks you are making money on and you keep those stocks, then eventually you'll make more and more money. And the trick is really just that. Figure out your mistakes and cut them off early, and figure out what stocks are good and keep them for a longer period of time. For example, my example would be Apple. I should have kept that for a longer period of time rather than selling it so quickly. And there's this phrase for it. It's called trimming the flowers and leaving the weeds. So if you have a portfolio where you're selling every stock you ever made some money on, but holding on to the stocks you lost money on, it'd be the same thing as having a garden where you cut down the flowers and leave the weeds. So it's not a nice garden. It's not, particularly productive. Okay, so that is it for this chapter.